How beginners can start investing. Using AI for decades, investing felt intimidating. It seemed like a world reserved for financial analysts, hedge fund managers, and people who spent years studying markets. Beginners believed they needed deep technical knowledge, constant chart analysis, and access to insider-level research to even stand a chance. Many never started simply because they felt overwhelmed before placing their first investment. But in 2026, the landscape has changed dramatically. Artificial intelligence has lowered the barrier to entry in ways that were unimaginable just a few years ago. The same type of analytical power once used exclusively by institutional giants is now available through simple apps and online platforms. AI can scan markets, analyze trends, evaluate risk patterns, detect anomalies, and suggest portfolio allocations in seconds. What once required teams of analysts and expensive software can now be accessed by anyone with a smartphone and an internet connection. The question is no longer whether beginners can invest. The question is how they can use AI to start investing smarter from day one. If you are new to investing, the path forward does not have to be confusing. With the right approach, AI can become your assistant, helping you avoid common beginner mistakes while building confidence step by step. Instead of feeling intimidated by financial jargon and market volatility, you can rely on structured tools that simplify decision-making without removing your control. 1. Understand what AI actually does in investing. Before relying on AI, it is important to understand its role clearly. AI does not guarantee profits, eliminate risk, or predict the future with perfect accuracy. What it does exceptionally well is process enormous amounts of data at speeds no human can match. It evaluates historical price movements, company earnings reports, economic indicators, interest rate trends, sector performance, and even investor sentiment. Large institutions like BlackRock use advanced AI systems to stress test portfolios across thousands of economic scenarios. These systems simulate recessions, inflation spikes, market crashes, and recovery cycles to understand potential outcomes. While beginners do not access tools at that scale, modern investment platforms use similar principles in simplified formats. AI identifies patterns and probabilities, helping investors make more informed decisions based on statistical likelihood rather than guesswork. AI also reduces emotional bias. Humans naturally react to fear and excitement. When markets fall sharply, panic selling becomes tempting. When markets surge, overconfidence can lead to reckless buying. AI tools offer a data-driven counterbalance, highlighting whether a move aligns with long-term strategy rather than short-term emotion. However, AI remains a tool rather than a magic solution. Understanding this distinction is critical for beginners. 2. Start with an AI-powered brokerage or robo-advisor. For beginners, simplicity is critical. Instead of immediately selecting individual stocks, starting with an AI-powered robo-advisor can provide structure and discipline. Companies such as Betterment and Wealthfront use algorithms to assess risk tolerance, allocate assets automatically, rebalance portfolios over time, and optimize tax efficiency. After answering a series of questions about financial goals, income stability, time horizon, and comfort with risk, the platform builds a diversified portfolio, typically consisting of exchange-traded funds. These ETFs spread investments across hundreds or thousands of companies, reducing exposure to any single stock's volatility. The AI system continuously monitors market conditions and adjusts allocations when necessary. This approach allows beginners to start investing without the pressure of choosing winning stocks. Over time, as you gain confidence, you may decide to explore individual investments. But beginning with diversification builds a stable foundation. Consistency and risk management matter more than chasing quick returns. 3. Use AI stock screeners to narrow opportunities. Once comfortable with basic portfolio investing, beginners may explore individual stocks. AI-powered stock screeners simplify the research process by analyzing thousands of companies simultaneously. Platforms like Kahoot use machine learning models to assign predictive ratings based on revenue growth, earnings consistency, profitability margins, debt levels, and momentum indicators. Rather than manually comparing dozens of financial metrics, beginners can use AI to narrow the field to a manageable number of strong candidates. This saves time and reduces analysis paralysis. However, screeners should be viewed as filters, not final decision makers. 4. Let AI help you manage risk. One of the biggest reasons beginners lose money is poor risk management rather than poor stock selection. Concentrating too heavily in one sector, ignoring diversification, or investing money needed for short-term expenses can create unnecessary stress. AI tools help monitor volatility, sector exposure, and asset correlation. If a portfolio becomes too concentrated in technology stocks or overly exposed to high volatility assets, certain platforms suggest rebalancing. Many brokerages now include AI-driven alerts that notify investors about unusual price swings or sudden changes in risk profiles. 5. Use AI sentiment tools carefully. Markets are influenced not only by numbers, but also by psychology. AI sentiment analysis tools evaluate financial news, earnings calls, and social discussions to measure optimism or fear surrounding specific stocks or sectors. Platforms influenced by behavioral data firms like MarketSite transform emotional signals into measurable indicators. For beginners, sentiment tools can offer valuable context. 6. Automate consistency instead of speculation. Perhaps the most powerful way beginners can use AI is through automation. Automated monthly contributions, dividend reinvestment, and scheduled portfolio reviews create consistency. AI-driven systems execute these actions without emotional interference. Dollar cost averaging, where fixed amounts are invested regularly regardless of market conditions, reduces the stress of timing decisions perfectly. Over months and years, this strategy smooths out volatility and builds steady accumulation. 7. Build financial knowledge. Alongside AI, while AI simplifies investing, it does not eliminate the need for financial literacy. Understanding what stocks represent, how ETFs function, the role of bonds in stabilizing portfolios, and the concept of compound growth builds confidence and resilience. Investors who rely blindly on signals without understanding underlying principles increase their vulnerability to market swings. The most effective approach combines human understanding with AI efficiency. Technology accelerates analysis, but judgment remains human. As your knowledge expands, your ability to interpret AI recommendations improves. Education transforms AI from a basic assistant into a powerful strategic partner. You do not need a large sum of money to begin investing. You do not need advanced degrees or perfect market timing. What you need is a structured plan, diversified exposure, and AI tools that assist rather than dominate your decisions. Artificial intelligence is one of the most powerful investing assistants ever created. It processes data, highlights patterns, monitors risk, and supports discipline. But your mindset, patience, and long-term consistency ultimately determine success. Start small. Stay consistent. Learn continuously. Let AI enhance your process without replacing your responsibility. The opportunity to begin has never been more accessible. With the right balance of knowledge and technology, beginners can step into investing confidently and intelligently. The best time to start was yesterday. The second best time is today.